Welcome back, everyone. Today on the Joseph Carlson Show, we have a special episode. We finally get a hair from Chris Hohn. Chris Hohn is a legendary investor, one that I've followed for a long period of time, but I followed him through text, through press releases, because he rarely ever does any type of interview appearance. You can read about his results, which are phenomenal. He's had around 17 to 20% annualized returns for the past decade, beating out both the S&P 500 and the QQQ. His fund manages $42 billion. It's massive. This is an incredibly huge fund. He's been rated by Bloomberg as one of the top fund managers in terms of performance year after year after year. Chris Hohn is a legend that we never hear from until now. He made an appearance on the Norges Bank investment channel where he did an hour-long interview, and this was by far the most insightful, interesting public appearance he's ever done. He highlights the intricacies, the elements of his investment philosophy, how he views different companies, how he establishes the moat, how he views different aspects of a company, like their revenue model, how he views when to sell a company or when to buy one. And this is particularly important for investors that like buying very high quality companies, because his portfolio is concentrated into only a small group of the highest quality companies. So we'll be going over this interview and I'll highlight what I found to be the most interesting aspects of it. Now, we also have some other 13F filings. This is, of course, where these super investors like the Triple Fund Partners, this is another high quality investment fund. They've made some portfolio changes. We also have Chuck Akre, we have Josh Tarasoff, and we have Polen Capital Management. They have a very similar portfolio to mine as well. All of these 13F filings revealing what they had in their portfolio at the end of March are finally released. So we'll be reviewing those as well. And then we have a bunch of other news to get to. Airbnb is going through what many people are calling a midlife crisis mode. They're making changes to their app, incorporating experiences and services and trying to make it an everything app. Do we have too many everything apps? We'll be discussing. Waymo, the Google robotaxi, is recalling 1,200 self-driving vehicles after a minor collision. This sounds like bad news, but how bad is it really? And then finally, the streaming service Max, that was once known as HBO Max, is now going to be called HBO Max again. This is the fourth name change within 10 years, and it highlights the incompetence of many of Netflix's competitors. We'll be going over this continual rebranding of these streaming services. So as always, we have a lot to get to in this episode. Now, we start today off with this incredible interview with Chris Hohn. And the reason that I was so excited to watch through this is because, frankly, Chris Hohn is an elite investor. He's in that very top tier category of the ones that I think are the most influential, most important to follow. He has a performance track record that beats Bill Ackman's. He's up there with Dev Cantasaria, right below Charlie Munger and Warren Buffett, up there with the greats. He's one of the few investment fund managers that runs a massive fund that has true alpha over the market, not through any form of gimmick, but just through value investing, buying incredibly high quality companies in a concentrated portfolio. And he's gone through a transition throughout his career. If you study Chris Hohn's history, you'll find that when he was starting investing, he did the thing everybody does. He bought cheaper companies, ones that seemed like they were value plays, right? Low PE companies selling at a discount to their intrinsic value. And then he found that those companies weren't that strong. He went through the 2009 financial crisis. At the time, he held a lot of financial companies and banks that got crushed. They were obliterated. His fund, TCI, was in shambles. It needed to be fixed, and he completely rewrote the strategy. From top to bottom, he changed everything about his fund. He decided then and there, going through that terrible experience, that he was not buying weak companies anymore. He would buy strong companies, companies that he considered to be monopolistic, companies with high barriers to entry, deeply embedded products, companies that had incredible balance sheets, that could withstand any type of thing that life throws at it, and they wouldn't have a problem. And his portfolio started to resemble more of this high-quality compounder portfolio. This success started to happen immediately after 2009. He had record performance years following that. Even though he went through this disastrous time during the financial crisis, his portfolio started to recover. Investors started to take notice, and he started to gather more assets under management once again. Now, as we see the evolution of his portfolio, before we get into this video, I want to take a look at it so you get an idea of what he owns. Again, his fund is called TCI Fund Management. It's a massive $42 billion fund. This is not the latest update. So this is at the end of 2024. We'll see what his portfolio looks like with an update later on this week, and I'll do a review of that. But what we know right now is the type of companies that he owns are ones like GE, Moody's, Microsoft, Visa, S&P Global, Canadian Pacific. He has Google, Canadian National Railway, more Google, and Ferrovial. Now, when we look at these companies, there's many that overlap with my portfolio. I also own S&P Global. I don't own Visa, but I own MasterCard, which is very similar. I own Microsoft. I own Moody's. I own Google. So I have a lot of overlap. He has a few differences here. He owns railroads, which I've sold out of, and he owns GE. Now, even looking at GE, he'll explain that this company has far higher barriers to entry than you may think. It has a very unique business model, and he's made a lot of money in this one. So this is the type of portfolio he has now. So let's jump into this. This is Chris Hohn here, and he goes over the definition of a moat. These are some of the qualities that a company needs to have a true competitive advantage.
Of barriers to entry is scale, although that's not a guarantee of competitive moat. Network effects is another important barrier to entry. You can see this in assets like Visa, Meta, two examples of network effects, and brands are another barrier to entry.
He names off three right off the bat. The first one was scale. Simply being everywhere and being ubiquitous is an advantage. That's certainly an advantage. If a company already has massive scale, if they're already across planet Earth, that's a big advantage. Companies like Meta, Netflix, YouTube, he names off Visa, those all have scale. But then he also adds in network effects. Network effects means that as more people use a product, it becomes even more likely that additional people want to use that product. For example, with Meta, that is a huge network effect. The more people that use Meta products, the more that those products get shared, the more clips that get shared, the more you get little text with a funny reel or something, and then you're back on Meta's product. So usership begets usership. That's network effects. And you see the same thing with Visa. It has a reinforcing moat. You even see a little bit of it with Netflix. As more people watch the shows, it gets more buzz, it causes more people to watch them. And then he finally mentions brand. Now, brand, of course, is an important one, but I personally think that brand is one of the weaker moats. A lot of new investors believe that brand is like the most important moat, but I believe it actually is one of the weaker aspects of a moat compared to network effects and scale. If a company, or if I had to pick between having strong network effects and having strong scale, or just having a good brand, I would personally pick the network effects and scale over the brand. And we've seen many examples of this. Facebook had such a poor brand, they had to rename their entire company. That was to get rid of the baggage of Facebook. Yet network effects and scale caused Facebook to succeed despite their poor reputation. So it's good if we have great brand, that certainly helps, but I would say that it's one of the weaker moats.
And I'll mention one more moat, which is customer switching costs. Take mission critical software. Once it's installed, companies are very reluctant to mess with it and switch because of the complexity.
When I think of switching costs, I think of when a company's product becomes so integral in your process that it's very cumbersome to switch out of it. You can name examples like ServiceNow or Salesforce. These companies become part of your company. You build upon them, and then it becomes more and more difficult over time to switch off of them. It's not impossible. And if there really is something way better than them, companies will switch, but it does make it a little bit more difficult. You have to have something very enticing for you to switch off of different companies like this. Companies with low to no switching costs are ones like Netflix and Texas Roadhouse. You can eat anywhere. You have to choose to go to Texas Roadhouse every time. With Netflix, it takes 2 seconds to cancel. They only have month to month. So these companies don't rely on switching costs as part of their moat. Now, this next question, he says something that I think is really interesting. It's a take that I haven't heard illustrated quite like he says it. He's asked about the importance of recurring revenue streams, which piques my interest because many of the companies I own are ones that are on monthly subscriptions, yearly contracts, that type of thing.
How important are recurring revenue streams for you when you look at businesses?
It is important, but the predictability of when they recur is not.
If you weren't paying close attention, you may have missed the important nuance here. He says that having a recurring revenue stream is important, but knowing precisely when you're going to get those recurring revenues is not important. And this is a very interesting distinction. I haven't heard it phrased quite like that, but I really like this distinction. And immediately when hearing this, I thought of the same group of companies he did. Let's go ahead and listen to him explain this point.
What's most important for us is something slightly different, which is essential product or service. We don't like things which are discretionary. Okay, so one space we've invested in for a long time is rating agencies. You can actually defer, an issuer pays for the rating, but they don't have to refinance their bonds, which is a big part of it in any given year. They can delay and defer, but eventually the debt has to be refinanced and rated.
He brings up the rating agencies as an example of companies that you can invest in that you will have recurring revenue, but you don't know when you're going to get that recurring revenue. And what I would do is just expound on his point here. The way that I look at the rating agencies is they're like a toll booth put on this very busy bridge of all corporate debt. Anytime a company issues corporate debt, they have to get it rated, otherwise they get a higher interest rate. And so you have Moody's, S&P Global, and Fitch as the three credit rating agencies rating this debt. Moody's and S&P Global alone rate over 95% of corporate global debt. So it's a massive number. They're basically a de facto duopoly rating all of this debt. Now, what can happen is based on macroeconomic factors with interest rates, companies that have outstanding debt can kind of defer it. They don't need to take out more debt. They don't need to renew it that year. Instead of refinancing the debt, they can continue to pay the minimum payment for some time. They can defer the refinancing for year after year, but eventually they will have to refinance the debt. They're not going to all pay off the debt and never take out debt again. That's not what's happened with global markets for the past 30 years. So when we look at these companies, the way that I visualize it is they're the toll booths on this busy bridge. But sometimes if interest rates go higher, the bridge can become less busy. Some cars can wait outside of the bridge. They can stack up and they can just wait for interest rates to come back down. But these cars are stacked one after another waiting to be rated. They're just piling up. Eventually, the environment will be right, or these companies will be forced to refinance their debt and get it rated. So it's not that Moody's or S&P Global makes any less money overall. It's just that we don't know precisely when these vehicles will pass through this toll booth. And that's the point he's making, that when you're looking at companies, you want essential services where you know that eventually you're going to get that revenue. It's just a matter of time. Now, next he's asked about the subject of pricing power. He has companies that have immense pricing power, and he expounds on what causes this to happen, how these companies grow revenue and the different forms of revenue growth.
And growth can come from two forms, volume and price. So you have to break it down. Now, why isn't growth as important as investors usually assume it to be? The airline industry over 100 years has had a lot of growth. Airline travel has grown at 5% a year. Continues to grow consistently. But airlines as a business, cumulatively and collectively, have made almost minimal profits, despite growth, because of the very low barriers to entry.
Now, it's interesting, as an investor that has these companies that seem like great growth companies, he's de-emphasizing growth, saying it's not the most important thing. Having companies growing top line 10, 15, 20% doesn't seem like the main metric he looks at. He wants great compounding from companies, but more importantly, he wants companies that have high gross margins, high operating margins, high profit margins, companies that don't dilute away all their growth from the shareholders. He needs companies that are highly profitable, both with capital expenditure involved and with employee expenses involved. When you look at airlines, they're just the opposite. Now that he established these companies that are simply growing top line, but they're not creating any value, he goes over the group of companies that are creating real value through their pricing power.
Most companies don't have pricing power. They can only price, if they're lucky, at inflation. And that's why people don't focus on it. They don't even look at where growth comes from. They just assume it's volume plus inflation. But there is a special group of super companies that can price above inflation. And that's, as Buffett taught, the test of whether you have the moat. Okay? And this real pricing power above inflation can be very valuable. Because if you can price 1% above inflation and you have a 20% profit margin, your profits will grow 5% faster than revenue.
Do you see the simple math there? Just slightly pricing your revenue above your costs will make it so that you're growing profit substantially. Just that slight bit of pricing power increases margins over time so that even moderate revenue growth equates to these incredibly profitable companies over long stretches. But if a company is commoditized, if it has no pricing power, it can't accomplish this. So the haves and have-nots with the pricing power separate all these weak companies, or rather just mediocre companies, from the truly exceptional ones.
This is something we have a lot of our investments have this.
Because incremental pricing is pretty much all profits.
That's right. And it's very potent if you have the lower your margin is. So this is why you asked about growth, and is it how important? If you ask about volume growth, I have low volume growth, but I have a lot of pricing growth, that's actually more important because of the leveraged effect of there's no cost associated with it.
He states that pricing growth is more important than volume growth because with every new customer, you have costs associated with it, especially if you have just normal margins as a business. For example, if you bring in a new customer to your diner, you have to pay for the food, you have to serve them, you have to do all this stuff to earn that extra money. Whereas if you can just charge your current customers more money for the same thing, that all falls to the bottom line. So this obviously makes it for every company that pricing growth is more important than volume growth. Now, what I see personally is in my portfolio, I've seen companies do this both ways, and I think both of them are important. I like companies to grow both in volume and have pricing power on top of that. That's what I'm seeing with companies like Texas Roadhouse, Costco, Netflix, Booking, Microsoft. You see this volume growth. They just get more and more customers, and they can increase prices ever so slightly. The combination of both are great, but I do agree with him. If I have to just pick one, I think that pricing growth is more important to a company, and it's more difficult to find. Now, so far, we've talked a lot about qualities of a company, good companies, bad companies, good moats, bad moats, pricing power, volume growth, all that type of stuff. And we get to the point of valuation. And this is my favorite point that he makes because this isn't what most people think a truly great investor will say about valuation, but this rings true to me. He talks about valuation in a very similar view that I view valuation.
We don't even look at that until we get comfortable that the barriers are so strong it will be around.
In his mind, valuation comes last. Now, a lot of people say it comes first. You just look at valuation and you target the companies that are trading at the deepest discounts. That's not how he views it. He has the highest quality companies in the world. He makes sure that they have sustainable, durable advantages. And then he considers valuation after all of that work is already done.
One of the things we learned is, there's a really important point, is that we can have an advantage through long-termism, okay, which is the average stock is held by an institutional investor by under a year, or the stock market in the US.
How long do you hold it?
Our average holding period of our current portfolio is 8 years.
8 years.
Yeah, 8 years. I'm not saying that's the limit. It's just we've on average, some we've held for 13 years, some new investments like GE Aerospace 2 years, but the weighted average holding period is 8 years.
Chris Hohn is once again correct here. The investors that focus on buying high quality companies, holding them for long periods of time, letting them compound unabated, are going to outperform the investors that are continually selling out of their companies because the PE ratio went a little too high, or the free cash flow yield went a little too low. The investors that do that are constantly turning over their portfolio. They're clipping the flowers and watering the weeds. When I look at my own portfolio, it's back near all-time highs. This one has outperformed the S&P 500 and the QQQ. And when I look at the companies that have truly made the difference, the ones that have had exceptional performance, I did focus on valuation a little when I was buying into them. I didn't want to buy at extremely high prices, but more importantly than that, once I bought into these great companies, I simply held. I just didn't sell. Costco being an example of that. The amount of times that I've had people ask me, why aren't you selling Costco? Even though the PE ratio is 35 or 40 or 50 or 42 or whatever it may be, the PE ratio is always a bit high with Costco. And the amount of people that have told me or asked me why I'm not selling, saying that I'm making a big mistake, I can't even count. It's literally dozens and dozens and dozens of times over the course of the past 6 or 7 years. I first bought into Costco back in 2017. When we look at the position now, the total value of the position is $85,700, 51,000 of that being gains. So the overwhelming majority of this position is purely from gains. So sure, I could sell it now and take the gains, I could pay the taxes on it and try to find another Costco, or I could just hold this company for the next 20 years. More than likely, Costco has found out something that's very difficult for other companies to replicate, and the success is not over. These type of companies come once in a lifetime. They don't come every day. They're not in the market. There's not thousands of these type of companies in the market. There is one Costco. So overall, some great points by Chris Hohn. I agree with the majority of it, and I think it makes sense of why he's doing so well. We'll be looking at an update on the TCI portfolio later this week or next week as we go over a lot of these 13F filings. Now, as we go through this week, once again, we're seeing the 13F filings come out, which is the super investors filing of what they owned the end of March. We have March 31st, 2025. This is their Q1 ownership. We have here Triple Fund Partners. Now, this is one that I haven't followed as long, but they're in the basket of the high quality compounding portfolios. You see some very similar names here. The largest holding is Microsoft with a 20% position. When we look at what they're buying and selling, let's just take a look at this. We have the biggest changes to the portfolio, and the one that they sold out of entirely this last quarter was Visa. Now, I don't necessarily believe that Visa needed to be sold. The company's in great shape and at a decent valuation. But when we look at what they did here, they didn't just sell Visa, they purchased into ASML. Buying this as a new position at 7%. They also added to Microsoft and they bought into Meta. So they sold Visa and bought into these three companies. They rather added to Microsoft. An interesting trade there. Overall, I don't mind it. I think that ASML is more undervalued than Visa, so I don't mind that transition. I have to admit, as much as I like Canadian Pacific and Visa, I don't mind this trade at all. I think overall it's a decent trade. Another thing they did was they reduced their stake in Google. This makes sense. Google's becoming less predictable, less forecastable as you have ChatGPT and other LLMs growing. And I think the investors are looking at this, in many cases saying, Google's a great company, but it's becoming a little bit more questionable. And instead of just plowing money into Google, I could buy Meta, ASML, which are also very good companies, very predictable, but aren't facing the same existential challenges. So I understand the logic behind it. I still have the feeling right now that Google's going to be fine. Based on these trades, Triple Fund seems like they're well managed. I like the trades. I like the thoughts behind them. I think it's a great portfolio. Next up, we have Chuck Akre. Now, this is Akre Capital Management. And the big caveat here is even though it's under his brand name, kind of his image, he's not running this portfolio anymore. He has his new people running it and managing it. And you can see the differences. In many cases, what they're doing is they're reallocating money from the old compounders to what they consider to be the new ones. They've sold out of or reduced their position in American Tower Corp. They reduced it in Moody's once again, MasterCard once again, KKR, O'Reilly, CarMax, Visa, and they've added to Airbnb, CCC Intelligent Solution, and they added a little bit to Brookfield Corp. But overall, a lot of reductions in these more legacy compounders. The Akre portfolio is fine. It's full of a lot of great companies, but I don't like the way it's being managed. They're selling out of a lot of these companies that have done really well for decades of time. We have MasterCard and Moody's that they're just continually selling out of for other ones like Airbnb. So by reducing their position in these companies, buying more Airbnb, I believe they're actually weakening their portfolio. Now, next up, we have Josh Tarasoff. We can see what he's up to. Recently, I've been a bit critical of Josh Tarasoff's trades. I just haven't liked the different decisions he's making, selling out of, again, what I believe are some of the strongest companies in his portfolio. Now, right now, he has a great list of companies. He has Amazon, Berkshire, Brookfield Corp, Markel Group, Trupanion, Tesla, Google, and Burford Capital. So very concentrated, the majority of it in Amazon. When we look overall, what I notice is that there's net reductions. He's reduced a lot more than he's bought in, which means one of two things. Either he's raising cash or he has redemptions, meaning some investors are pulling money out of his fund. I believe it's more likely that he has redemptions. Because of some poor performance recently, there's probably some investors that are taking money out of his fund. I believe this is more redemptions like what he had to do last quarter. You can see that he had all net reductions last quarter, and I see nearly the same thing this quarter. There must be some of his big investors taking money out of his portfolio every quarter. Now, Polen Capital is this large investment firm. They manage $31 billion in all these different funds, but their growth fund, I believe, is the most relevant. We have it right here. It is heavily diversified. So the largest position is Amazon at 10%. Then we have Microsoft, Visa, Oracle, MasterCard, Abbott Labs, Shopify, and so on and so forth. We have dozens of companies here. If we look at the biggest trades as of Q1, we have them adding to AON PLC. I was not familiar with this company. Anytime I'm not familiar with a company, I just bring it up in Qualtrim. It gives me the fastest overview of it. AON is a professional service firm, provides advice and solutions to clients focused on risk, retirement, and health worldwide. So this is one of these firms that goes to a company, seems like a consulting firm, maybe a little bit like Moody's Analytics that gives you risk factors. When I bring up Qualtrim here, it highlights the competitive advantages of the company, resilient organic growth and balance across solution lines. AON delivered consistent mid-single-digit organic revenue growth, 5% in the quarter, across commercial risk, reinsurance, health, and wealth solutions, reflecting strength and balance in its diversified business model. New business wins and improved client retention underpins the resilience even as market conditions fluctuate. They have further integrations into their platform. They say innovation through AON business services and analytics. The company's ABS platform and risk capital analyzers are creating tangible operating leverage, funding ongoing investments in enabling advanced data-driven client solutions, the rollout of proprietary analytic tools such as supply chain diagnostics and health risk analyzers, increases value delivered to clients, differentiating AON from competitors. It seems like some of this has a bit of overlap with something like Palantir, or again, maybe Moody's Analytics. You have enabling analytic data-driven client solutions. It's a bit of a flowery mouthful there, but it seems like they are an analytic business service solution. The company's also free cash flow generative, generating $84 million in free cash flow in Q1. So that is a very interesting one that they added to the portfolio. Maybe this is a good one to look at. And again, this type of thing is where I get many ideas for my companies. I see them show up on various super investor lists, they filter through them, then I do some research and see if they spark my interest. Overall, Polen Capital has a great portfolio. I like a lot of the names in it. My only criticism for this fund is that they do a lot of trading. They've said themselves that this trading hasn't mathematically worked out to make it more beneficial, but they still continue to try this strategy. I think they'd be better off identifying the compounders and letting them grow. Now that's 4 different 13F filings, but we have many more to go through. Investors like Bill Ackman, even Chris Hohn, Dev Kantesaria, and so on and so forth. So if you want to see me go through and do some analysis on those 13F filings later this week, just make sure you subscribe to the channel. Now, as we move on, we had some interesting news, which was Airbnb has recently released a new update to their app that changes the direction they're going to everything. They're now advertising it as an everything app, and they're opening up the total addressable market, trying to become bigger and bigger. And this is what many people are calling or labeling a midlife crisis mode. It's like the company has run into a roadblock, so now they're opening up every direction all at once. And Brian Chesky there, the inventor of Airbnb, the CEO, the founder, he's the one that's just running the company right now. He's the one that decided to go this direction. Now, what he's trying to avoid is the one thing, the one label that no growth company wants to have. And that label is called mature. You don't want to be called mature in the growth category because maturity means that you're past your prime. In the investment world, it means that the past is better than the future, that you're going to slowly stagnate, you're going to just focus on some profits, and from there, you don't really have as much to offer. And Brian Chesky is desperately trying to avoid that mature label. Now again, the Airbnb app, as everyone knows, is synonymous with staying in some random stranger's house. They rent out their house or the basement or a portion of a place, and then you go and you rent it out and you have to deal with them, and they are they're like the hotel for that night. Only unlike a hotel, you don't have the basic amenities that many hotels offer. So there's a big debate of whether or not a hotel is better or an Airbnb. There's pros and cons to each, but that's what people know the app for. And Brian Chesky is trying to change that. In this interview, he describes how he came about with this new direction of the company.
Where you could get almost anything to travel and live anywhere. The basic idea was you could be a global community in the real world where you can travel anywhere, live anywhere, belong anywhere. I wrote this document, I shared with the company when I came back from Thanksgiving, and I said, we got to get this out by 2025. We got a year and a half to do it. And so at that point, it was all hands on deck. But it really was stemmed from that completely crazy weekend and all that energy I had bottled up.
And that weekend, of course, was when Sam Altman, his great friend, had been pushed out of OpenAI, and then there was this effort to reinstate him. he was literally
writing his changes for the app or for.
So apparently it was that weekend when he was with Sam, and they were like in a foxhole together trying to figure out how to keep Sam in the job. And for whatever reason, that sort of energy of just working 24 hours a day and trying to figure out what was going to happen, frankly, at OpenAI, turned out to be an extended weekend. I think Sam ultimately maybe got the job back by that weekend,
right.
Or maybe by the end of that weekend.
It was before the market opened.
And he decided that
Sunday night.
I think that, in a way, what he was trying to suggest was inspired him to say, you know what, I'm going to make my company a whole new thing.
Now, this all seems a little confusing. Where did Sam Altman jump into this story of Airbnb? Well, this whole thing apparently began when Brian Chesky helped save Sam Altman from being fired from OpenAI. That crazy week where Sam Altman was being replaced or fired by the board, Brian Chesky was the key figure that stepped in and really was in his corner, helping him out. To clarify this, if we look back at the timeline, on November 17th of 2023, the board of OpenAI fired company CEO Sam Altman. His friend Chesky leapt into action, publicly defending his pal on X, getting on the phone with Microsoft's CEO, and throwing himself into the thick of Altman's battle to retake OpenAI. 5 days later, Altman prevailed, and Chesky said, quote, "I was so jacked up," he says, "this turned his buzzing mind to his own company, Airbnb." Thanksgiving weekend was beginning. The Chesky extended family had already held their turkey get-together a week earlier, and the Airbnb CEO had no holiday plans. He was completely alone in his sprawling San Francisco apartment, except for Sophie, his golden retriever. Still wired out of his mind from the cathartic corporate rescue, Chesky began to write. He wanted to bust a company he co-founded out of its pigeonhole of the short-term home rentals. Amazon, he was fond of pointing out, was the first online bookstore before it became the everything store. Now Chesky was emboldened to lay out his vision. Home rentals are simply a service, so why stop there? Airbnb could be the platform for booking all sorts of services. While other apps cover specific sectors like food delivery, home maintenance, car rides, Chesky figured that Airbnb's experience in attractively displaying homes, vetting hosts, and responding to crisis could make it more trustworthy than competitors and therefore a go-to option for virtually anything. In a frantic typing spree at the dining room table, on the couch, the bed, and at times in the office, Chesky spec'd out how he could redesign the Airbnb app. Its users, now at 2 billion, would open up the app not only at vacation time, but whenever they needed to find a portrait photographer, a personal trainer, or someone to cook their meals. Chesky reasoned that Airbnb would need to significantly strengthen its identity verification. He even thought that he could get people to use the app as a credential, something as respected as a government-issued ID, if he could transform Airbnb into a storefront for real-world services. Chesky thought that he'd catapult his company from a nearly $10 billion a year business into one that boasted membership in tech's pantheon. So this guy helps save Sam Altman's job, gets him back to OpenAI, and then he's just infused with this idea that he's working on. And I think this is what separates people that invent companies like Airbnb and continue to grow them from the average person. How often do you get this much energy to work on a project that hard where you can't even put down your laptop? You're working on it day and night, every single day, trying to start something great. This is what he's doing. Even though he's rich, even though he could be on a beach relaxing, he's trying to totally reinvent his company. Now, after the holiday, Chesky gathered his leadership team into a conference room. He handed the team copies of his memo, a la Jeff Bezos. So you can see that these entrepreneurs, they're just like anyone else. They look at the bigger, better companies, the ones that have really pulled this off, and you have Jeff Bezos as the example. The thing where you hand out memos and have everybody read through the memo before they give their input is what Jeff Bezos was known for. He talked about it in interviews. He says, usually when I share ideas, people aren't bought in, but this time there wasn't a lot of feedback. People were really excited. Now, how do we see all this implemented into Airbnb? This month, Airbnb will launch its first stage of its more than $200 million reinvention, a panoply of more than 10,000 vendors peddling a swath of services in 260 cities in 30 countries. It has also revitalized an unsuccessful experiment the company began in 2016, offering bespoke local activities, or what is called experiences. The next stage, the launch date, unspecified, involves making your profile on Airbnb so robust that it's almost like a passport, as Chesky puts it. After that comes a deep immersion into AI. Inspired by his relationship with Altman, Chesky hopes to build the ultimate agent, a super concierge who starts off handling customer service and eventually knows you well enough to plan your travel and maybe the rest of your life. And there you have it. There's the great reinvention of Airbnb that was announced yesterday. You have the CEO, the founder of the company, completely bought in. Right now, investors aren't sure what to make of it. Airbnb stock has been relatively flat since this announcement. It's up 6% year to date. So investors are still on the fence. A lot of them are kind of awaiting what's going on. But part of me hopes that he's successful. Even though I don't own the stock, I'm not invested in it. I love founder stories like this. I love companies that are able to transform. There's going to be a lot of competition with the super app. We have companies like Uber, we have Booking Holdings, we have X, we have all these companies wanting to become the everything app. One of them will likely dominate, and it's difficult to pick which one. But time will tell whether or not Chesky's correct in Airbnb being that one. Now, moving on, we also have the headline that Waymo has apparently recalled 1,200 of their self-driving vehicles after a minor collision. That doesn't sound good. We know that Waymo is owned by Google. It's part of the bull thesis. Waymo is a very small portion of Google, so it's not a very important part right now, but it has a ton of potential. And what we've seen so far is the data that Waymo is far safer than human drivers. So having all these vehicles recalled sets off some alarms. Waymo is recalling more than 1,200 self-service vehicles to update software and address risks for collisions with chains, gates, and other road barriers after U.S. auto safety investigators opened a probe last year. 1,200 vehicles is almost all of their vehicles. They have over 1,500. Now, Waymo said it's aware of 16 collisions with chains, gates, and other barriers between 2022 and late 2024. So we have 16 collisions over the 2 years with specifically chains, gates, and other barriers. So this seems like one of these edge cases that they've fixed in newer updates. The issue has been fixed with its latest 6th generation self-driving software, Waymo said, adding it had deployed its latest ADS software version across its entire fleet by the end of December. So basically, this is being reported today that they're doing a recall. This problem was fixed last year. The solution to it has already been implemented for months. I mean, we're going on 4 or 5 months now where this is already behind us. So we're hearing about a problem that's already been fixed for months. Waymo has been ramping up their drives every single week since then. Waymo provides more than 250,000 paid trips every week in some of the most challenging driving environments in the United States, the company said. Now, Google today that owns Waymo is in the green by 3.5%. And one thing that we can look at is the amount of Waymo weekly paid rides. We can see this over time. In Q1 of 2024, it was 10,000 per week. Then it went up to 50,000 the next quarter, 100,000 the quarter after that, 200,000 the quarter after that. And then in Q1 of 2025, it's up to 250,000. This is based off all the different press releases they've given. So over this time period, Waymo is rapidly expanding in scale, and I want to see more of it. As an investor in Google, I see this as right now a small portion of Google, but a rather exciting portion. They have the model working, they just need to scale it up. And I believe that these type of recalls and little edge cases are going to get fixed. One of the nice things about these type of robotaxis is anytime one person has a problem or there's one crash, they can immediately learn from that and implement a code release in their entire fleet of vehicles so that every vehicle learns from it, which is different than human drivers. Human drivers have to learn from their own individual experience. Waymos learn from any single experience from any one of them across their network. It's also important to note that no one got injured in any of these accidents, so none of them were life-threatening whatsoever. Now, finally, we get to an example of corporate incompetence. Max, HBO Max, that's what it was called. Currently, it's called Max. Now, they say that it was once known as HBO Max, is calling itself HBO Max again. If you're confused by this, that's because this is very confusing. Warner Brothers Discovery executives are reinstating the name HBO Max for the popular streaming service. It's the 4th name change for the app in the last decade. The reason for the change was surprisingly straightforward. People who subscribe and pay $17 a month for the streaming service wind up watching HBO content like The White Lotus and The Last of Us, as well as new movies, documentaries, and not a whole lot more. So basically what went on here is Warner Brothers Discovery has one of the most exceptional media properties in the world, which is HBO. This is the icon of entertainment. These prestige drama series that other companies could only envy how they're able to create this on a continual basis. And then the geniuses at Warner Brothers Discovery, these executives and the paid people they have doing their advertising and branding, said, let's go ahead and switch it from this iconic prestige brand that you've developed over decades of time, HBO, to a name that's so bland, uninteresting, like Max. Let's get rid of all of this prestige name brand value and name it Max. So that's what they did. Now, for a time, they wanted to combine both of it, so they had it as HBO Max. Then they decided to change it to just Max and ditch HBO. And now they're finding out that when people sign up for just Max, basically all they watch is just HBO. So now they're combining them back together, which is HBO Max. This is an illustration of extreme incompetence from the management team, from the executives, from the branding team that they have over this. Now, to put this timeline in perspective, here's just the past couple of years. In 2022, that was the logo, HBO Max. 2023, a purple Max. 2024, a blue Max. 2025, a black Max. 2025 again, now HBO Max in black. So not only are they changing the actual name of it, but they're actually changing the branding along the way multiple times. It seems like they just have someone new coming in every year and saying, no, let's go ahead and change it to this. This is our problem. It's a problem with the logo. If we compare this to Netflix, this is what it looks like, okay? We have Netflix here. Now, in 2000, when it was a DVD service, it had this old school logo. 2001, they switched it up. And then since 2001, they changed it to this iconic logo that is almost identical to what it is today. That means that for the past 25 years, Netflix's logo has remained almost identical. The same words spread out, getting a little bit larger towards the edges, the same typeface. They've had some minor updates to make it slightly more modern, but no changes in color, no changes in the name of it. The same logo for 20 years. Now Netflix is one of the most recognizable brands in the world. This is one of the most poorly performed executions in rebranding a company I've ever seen. The amount of inexplicable changes in logo, in typeface, in color, in branding over just a 5-year period is incredible. And if Netflix had it already pretty easy because they have the lead, they already have a lot of momentum, it's good for Netflix that their competitors in many cases are completely incompetent. It makes it a lot easier for Netflix in the long run. That's going to be it for this episode. Hope you enjoyed. See you in the next one.